Good evening, ladies and gentlemen. Welcome back to the Australian Gold Weekly Review. This is episode 10. Apologies for the mistake that I made in the last episode. I did mention that we're shooting episode 8 while we were actually shooting episode 9, and Mr. Brian brought it to my attention. So thank you so much for that. Otherwise, I would have been saying welcome to episode 9 today. So welcome to episode 10, everybody. And we're glad to have you back once again for the weekly review. If this is your first time watching, welcome. We uncover everything that is essential for your gold and gold stocks investing journey, which is movements in gold, silver, oil, the ASX Gold Index, as well as specific gold explorers and producers, which we think could add a lot of value to your investment portfolio and to our investment portfolios in the future. We want you to treat this series as a joint project between us and you, which means that if you have any feedback, please put it in the comment section below. We'll definitely read it and implement it in our episodes to come. We are trying to implement one of the feedback that we have received in our last episode, which is to keep the episodes within the 30 to 40 minute range. So hopefully that viewer would be happy watching this episode. And none of the content that we discuss in this video qualifies as financial advice. So if you're on the outlook of financial advice, we recommend that you seek a licensed expert. So without any further ado, let's get into the video and start with gold, the usual. Gold this week has increased in the US by 2.11% to $3,857 an ounce. And in Australia, it's increased by 1.33% to 5,847 Australian dollars an ounce. On Friday, the US inflation release landed broadly in line with expectations, allowing traders to keep rate cut bets alive and spot gold anchored near US dollars 3,780 into the weekend. On Monday, the market punched decisively through the US dollar 3,800 mark and set a fresh record as Washington's shutdown risk, which is the US government's shutdown risk, along with simmering geopolitical tension, drew safe haven flows back into gold bullion. By Tuesday, gold hovered near the peak and capped an extraordinary month. September's gain was on track to be the strongest since July 2020, underscoring that this is a sustained trend and not a one-day squeeze. We did see gold touch the 3,000, almost touch the 3,900 spot, probably around that time in the week. And midweek, the narrative intensified because with parts of the US government now shut and the ADP reporting a surprise 32,000 drop in private payrolls, spot prices printed an all-time high at US dollars 3,895, while futures settled just shy of US dollars 3,900, and markets priced an almost certain October Fed cut as the dollar weakened. Microstructure also mattered. India's physical market stepped in aggressively, with trade and government sources said September gold and silver imports nearly doubled from August as banks and jewelers built inventory ahead of festival season and a likely rise in base import prices. Local premiums were quoted up to about US dollars 8 per ounce. Whereas in contrast, China remained price sensitive with dealers widening discounts to roughly US dollars 31 to US dollars 71 per ounce below global benchmarks. Institutional flows also added a durable backbone, and this has been the topic of discussion when it comes to gold for the past few episodes of ours. Reuters highlighted that this year's run has been supported by renewed inflows into gold ETFs and steady central bank buying. Nothing new about that. Year-to-date gains now sit around 47% after a 27% rise in 2024. Together, that structural bid helped shallow intraday pullbacks around the US dollar 3,850 area, even as momentum cooled into the close. So to have a look at the overall picture, this week's tape shows gold responding to cyclic shocks, shutdown risks from the US government, softer job sprints, a weaker dollar, while structure pillars, which is India's festive restocking, ETF demand and central bank buying staying intact, and with spot consolidating just shy of US dollars 3,900 after a 2.38 advance, the focus now turns to whether policy, data, and flows can hand bulls the next leg higher, especially with the shutdown news of the US government. So on that note, Mr. Brian, do you think gold is expected to break above US dollars 4,000 next, or will it pull back first before resuming its rally?
That's a good question, Fed. The problem is it's actually very hard to read what's going to happen next, given the momentum that we've seen with gold and silver in the past 2 to 3 months, especially given that gold actually rose, and once it broke past $3,500 an ounce, it just continued to rise further, 3,600, 3,700. It didn't even pause when it went past 3,700 and then rocketed to 3,800. I have been on record on Ausbiz and also here about the potential for a correction. And even this morning, I had someone call me up and he's asking me about, well, where do I think gold's going to go? And I said, I believe there are grounds to believe that a correction for gold is possible. And if it does, it could head to 3,500. But which one's going to come first, $4,000 or 3,500? I am actually quite baffled. And I'm willing to actually say this on record that if where my money is that gold could correct to 3,500 first before it goes to 4,000. But my track record would show that I'm more likely to be wrong. So therefore, people are more likely to actually get it right if they put their money on $4,000, betting against me, saying that gold could probably head to 3,500 first. Now, what is the catalyst for gold potentially correcting to 3,500 is if the US government shutdown actually backfires against the Trump administration, leading to the market actually losing faith and people retreating to the safety of the US dollar rather than gold and risky assets in general. That's always possible because of how overstretched the broader market is. But where the grounds are for gold to continue to rise further and assets in general rising further is the US government shutdown could potentially require the government to actually borrow more to keep things going in order that so the Trump administration actually wins because they managed to bring the big beautiful bill forward, which requires more borrowing, more liquidity, and a weaker US dollar, which helps with gold.
Right. Thank you so much for that, Mr. Brian. I think we'll have to wait and see how the how the entire macroeconomic environment plays around and whether that supports your prediction of gold retreating back to 3,500, followed by a rally. So we'll keep macroeconomic news aside because no one can really predict what's going to happen. But as far as the track record of the Australian Gold Weekly Review is concerned, which always seems to fire up gold's rally after the release of every episode, I think that is one area that may lead you to being wrong about gold retreating back to US dollars 3,500. I'll tell you what, I've kept my trading view on just next to this Riverside studio, and I'm continuously tracking the price of gold as we speak, and I'm already seeing some green candles appear already. So we'll see what the road for gold ahead is. Moving on to silver. Silver followed suit with gold as it traded at US dollars 47.27, which is a 1.72% increase early Friday. Been some really exciting times for the metal for sure. And we've also had a viewer request a video on silver as well as silver mining equities listed on the Australian Stock Exchange. So we're definitely considering to make a video around that. So please stay tuned for that. And with that, we move to oil. And I think it's been a really interesting week for oil because oil prices fell almost 6% this week, dropping from US dollars 65.68 per barrel on September 26 to around US dollars 61.84 early Friday, which was today, which led the gold oil ratio to increase by 4.53 barrels per ounce to 62.43 barrels an ounce. That's the highest spike that we've seen in the gold oil ratio week on week for a really, really long time now. And the decline in oil prices came from a mix of new supply, softer demand signals, and cautious positioning by traders. So the week began with news that exports from Iraq's Kurdistan region had resumed. So about 180 to 190,000 barrels per day started flowing to the Turkish port of Ceyhan, adding fresh supply to the market. At the same time, traders were watching OPEC Plus discussions, with early reports hinting that the group could increase output in November. That combination of actual and potential new barrels put downward pressure on prices. Mid-week, US data reinforced the bearish tone, with the Energy Information Administration reporting a larger than expected build in crude inventories, along with higher gasoline and distillate stocks. That suggested weaker product demand, adding to concerns that the balance of supply and demand is tilting towards oversupply. On the demand side, fresh economic surveys showed manufacturing activity shrinking across Asia and Europe. These weak numbers fueled doubts that near-term oil consumption could potentially reduce, especially in refined products like diesel. There was a small rebound later in the week as markets reacted to news about tighter enforcement of sanctions on Russian crude, and that highlighted how geopolitical risk can still provide some support to oil prices. However, the broader trend remained heavy, especially with US rig count ticking higher, signaling that more domestic supply is on the way while questions are still rising around demand and consumption, at least in the near term, which has caused a bearish outlook for oil. So overall, this week showed that oil is being weighed down by growing supply and slowing demand, even as occasional geopolitical shocks provided short-lived support to oil. Moving on to the ASX All Ordinaries Gold Index. This week, the ASX All Ordinaries Gold Index jumped 1,046 points from 15,502.53 points on 26 September to 16,548.9 today. Now, usually when there's a jump such as this, which is 1,000 points, or, even when it was 700, 800, 900 points, I made it a point to emphasize on how much the index has increased this week, and I sort of always dramatized it in our previous episodes. But notice how I didn't do that in this episode, because it's just become a regular occurrence by now. And to me, it's just literally as if I'm reporting a piece of news that I've been doing for the longest time, I feel now. So what exactly led to yet another 1,000-point rally this week? It was strong gains in several mid to large caps. Westgold Resources was the standout. The stock surged after the company launched a 3-year outlook and detailed plans to lift throughput and replace lower grade feed, followed by an update on their Crown Prince open pit ore purchase that keeps the Mikathara plant well supplied. Westgold finished Thursday up 8.27%, helping drive the index higher. Among the major producers, Northern Star Resources and Evolution Mining both added to the rally late in the week, rising 3.85% and 3.72% on Thursday, while Bellevue Gold also gained 2.98%. Corporate flows also added support. Evolution Mining's 13-cent final dividend and DRP shares are due 3rd October, drawing income buyers ahead of the payout. Northern Star Resources flagged its September quarter release for 23rd October, which can attract positioning from institutions. And macro context also helped. Spot gold held near record highs around US dollars 3,866, sustaining sector momentum even as Australia's August trade data showed a sharp drop in non-monetary gold exports. Price strength outweighed the export dip for equities this week, however, which we are able to see in the jump that the index saw this week. So the net result, breadth was solid. Westgold led on operational news. Northern Star, Evolution Mining, and Bellevue added large cap heft, and Genesis Minerals provided midweek follow-through. With the index closing at 16,548.9 points, investors finished the week rewarding companies that paired operational clarity, which is mine feed, production plans, and upcoming catalysts in the case of Westgold Resources and Northern Star, with leverage to bullion near record levels. And that now, Mr. Brian's raised his hand. Mr. Brian, do you have something to say?
Yeah, I think it's worth commenting about the movements in the gold, the ASX Gold Index, and also what's happened to the producers. We are actually seeing price levels that for some of these companies we haven't actually seen since 2011. And I think 2011 is well before your time, Ved. You were probably in primary school, I believe. And I was just getting myself familiar with what's going on with mining, gold mining companies. Back then, companies like Perseus Mining was trading at about $4. We haven't seen Perseus Mining trade at $4 until recently, and it's now trying to touch $5. The difference between Perseus Mining in 2011 trading at $4 was the market cap was, I think, about $600 million, something like that. Today, Perseus Mining, trading at almost $5, is trading at $7 billion. And of course, the company has come a long way. Similarly, companies like Ramelius Resources, it broke above $4. It's a $7.5 billion company. 14 years ago, Ramelius Resources was I think, $300 million company. And its production has definitely gone quite a long way. The reason why I'm trying to bring up this point is, in 2011 September, everyone believed that gold was going to break above $2,000 an ounce. And when it didn't, it actually, of course, we had a lot of things happen in between. You had Ben Bernanke bringing in Operation Twist in order to change the shape of the yield curve in order to bring down inflation, which they actually did for about 2.5 years. That led to gold falling almost 50% in the space of 2 years. And of course, gold stocks went through a very, very brutal bear market. Now, how is it different this time? And I am actually going to be on record to say that it is different this time, because the Federal Reserve has run out of bullets to try to control inflation and not crash the market. Back then, they could control inflation, and they managed to actually not crash the market because they were able to deliver a lot of liquidity, and therefore, at that time, people could afford to borrow. Nowadays, we have a huge amount of liquidity. Debt levels are actually at unsustainable levels. And the only way that things are going to continue to refrain from crashing is if the governments around the world can continue to juice the economy, which is exactly what we're actually seeing. That's why all the central banks in the world are actually cutting interest rates. That is partly why these gold's trading at such record levels. Gold mining companies are also trading at record levels. It's also great news that a lot of these gold mining companies are actually repaying their debt. They also are quite disciplined in their acquisitions. We're not seeing outlandish prices being paid to purchase new mines or bring things to production. So on that end, that's why I don't believe that the ASX Gold Index is, given that how far it's run. If you look at the charts, 16,500 points. Same time last year, it was just above 8,000 points, and 2 and 3 years ago, it was 4,000 and 6,000 points. This is normally what I would call at 16,000 points bubble territory, and I do call it a bubble territory. But is this bubble going to burst anytime soon? Probably not, because most of these companies are actually in good financial position. I'm cautious, but I don't expect that things are going to go pop unless we do see a freak reversal in economic trends. I thought I'd bring this up just to get everyone to understand the unprecedented times we're in and the context in which gold and gold mining companies are operating.
Right. Thank you so much for that, Mr. Brian. I'm sure this is useful information for investors, especially from a valuation standpoint. So please put it down in the comment section below if you want us to make videos about how Gold Hub Australia specifically values gold mining companies, as well as how we value the industry as a whole and its standpoint relative to history and relative to the past. So if you are willing to see any valuation-based videos, please let us know, and we'll be working on them quite soon as well. Now, moving on to the Explorer in focus. The Gold Explorer in focus for this week is James Bay Minerals. James Bay Minerals stock price increased by 30% on Thursday and nearly 50% this week. This was after them coming out of a trading halt with a transformational deal, the acquisition of the high-grade Shafter Silver project in Texas from Orcana Silver. The halt, which was launched on 30th September, flagged a material acquisition and capital raising, which primed the market and the investors for news, and shares resumed with the Shafter announcement and a funding package, unleashing catch-up buying and momentum flows. But why did this deal hit so hard? What was so good about the Shafter project and its announcement, which caused the stock price to increase by 30% in a single day? So first, Shafter is an advanced, fast-producing underground mine on the northern extension of Mexico's prolific Sierra Madre belt, and it comes with substantial existing infrastructure, with reports citing approximately 160 kilometers of underground workings, 4 shafts, and a process plant, which implies a lower restart capex for the company, which is James Bay Minerals, compared with the greenfield build. Management also signaled a corporate refresh, which is a proposed name to Black Bear Minerals with the ASX code of BKB, framing Shafter as a near-term development platform rather than a long-dated explorer. Second, timing. Silver has been firm, liquidity has been rotating into developers with credible paths to production. So if you pair that macro news with a clear mine-ready asset and fresh capital, the setup for the multi-day re-rating was in place. A re-rating of about 30% increase in a single day. Coverage across resources media reinforced the narrative that JBY has moved into the silver corridor, pulling in momentum and thematic investors at the same time as well. Zooming out, JBY's most significant pre-deal asset has been the Independence Gold project in Nevada's Battle Mountain district, where the company defined a maiden 1.37 million ounces JORC resource this year. For those of you who don't know, JORC is a committee, joint ore reserve committee, and every single gold explorer, developer, and producer has to abide by the JORC code when they publish their resources and reserves statement. And it is because of the JORC that you see such, I would say, classification in the presentation of resources and reserves in terms of indicated, inferred, measured, proved, and probable. That gives a much clearer idea to investors about the scale of a company and what actually lies underground, which does fuel investment decision making. JBY also expanded their land position by 184% in May to strengthen both exploration and development options. And near-term work focuses on resource growth and study work around the near-surface epithermal and deeper skarn domains. The company also holds lithium ground at La Grande in Quebec's James Bay region, which is a useful optionality for the company. But this week's re-rate is about precious metals, particularly silver and the rally that we've been seeing around it, with clearer line of sight to production and lower capex costs for the company given the infrastructure already in place following the acquisition. So what's next for the company? For Shafter, diligence on historic data, scoping and development studies, and an updated plan for plant refurbishment and mine restart options, which are now funded by the announced raising. For Independence Gold project, ongoing drilling, studies, and permitting steps that can convert ounces into mine plans and valuation. So Mr. Brian, bottom line, now that we know what's next for the company for both their projects, the Shafter project and the Independence Gold project, and considering the status of James Bay Minerals as an explorer, does their infrastructure in place and silver's rally profile justify a significant change in JBY's valuation this week? Or should we wait for a concrete restart timeline first?
I was actually very excited about the announcement that James Bay Minerals made this week. Now, what attracted me to the company initially was because it owned high-grade gold and some silver in the Independence project, which you mentioned in Nevada. And the grades of the skarn deposit was as high as 6.5 grams per ton, 6.67 grams per ton, although it's the inferred category. In other words, it requires further infill drilling. You need to drill, the company needs to drill more closely in that area to confirm those drill holes were actually, the deposit is indeed reliably estimated. The company also has a large amount of surface ore. The grades are quite low, 0.35, 0.4 grams per ton. But because it's close to the surface, and I think as epithermal surface, so they are actually relatively easy to extract. So I thought that the company was well positioned for a re-rate, even before it's confirmed that it would purchase the Shafter Silver project. I thought the Shafter Silver project purchase was hitting it out of the ballpark, really, especially for the price that it paid at an implied market value of $30 million to purchase not only a silver deposit, but also a processing plant. Now, I think my viewers know very well that I love buying companies that are in the early development stage with a deposit that's mature and it comes with a processing plant on top. It's the same as buying a 1980s Ferrari and all I need to do is go and repaint the body, check that the engine had tuned the engine, changed the oil, and then I've got myself a really damn good car. Now, I'm not a mechanic myself, but I'm sure that I would be able to find a good mechanic to look after that. Just like in the case of James Bay Minerals, they need to check the conditions of the processing plant. They need to put a plan together on how much it costs to refurbish the plant, what types of parts need replacing, what permits they need to cross the T's and dot the I's in order to ensure that everything's up and running. You have something to add, Ved?
Yeah, I was just about to say, I don't know if this is factually true or not, but I'm assuming a 1988 Ferrari would also have extremely high intrinsic value. Whether people would see it or not, I think a 1988 Ferrari will also have a lot of high intrinsic value compared to what it was in 1988.
Yes, very much so. In fact, when you think about it, the cars that they used to make in the 80s, the engineering, I believe, is probably much better quality than what they make now. And there's also less electronics for things to really go wrong. So as long as a car was kept in a relatively good condition and the owner knows how to take care of it, I think it's got quite a number of years to run, and it's got definitely great collector value. So great point you make there. Now, after this acquisition, the market value of James Bay Minerals is, in my opinion, still very attractive. I think after incorporating the capital raising, the company is still worth about $130 million or something around that. And it is a potential silver producing company, which a lot of people are actually very interested in the Australian precious metal space. And as you mentioned, Ved, a lot of people are actually, some people have even left a message asking us, and I also get newsletter readers who ask the same thing. Can you recommend more silver stocks to me? Now, on the ASX, there isn't a lot of relatively mature stage silver mining companies in Australia because of the nature of silver deposits here. Firstly, a lot of silver deposits do not exist on their own. They exist in combination with either gold, lead, zinc, or if I remember correctly, sometimes copper as well. And a lot of these deposits would be larger in size and therefore run by major companies. Or if someone sits on a silver deposit that is anywhere remotely viable, they may actually face a buyer. Adriatic Metals, for example, which was recently acquired by Dundee Precious Metals in Canada, was a silver company that we had on the ASX, and we actually saw it develop the various project which is located in Bosnia and Herzegovina, and it only produced for about 2 to 3 quarters in Australia before Dundee Precious Metals came and swooped it for about $1.5 billion. Polymetals Resources recently started producing. They revived the Endeavour mine over near Broken Hill. And the market cap right now, I think is about, let me just quickly check, I think it's about $400 million. So James Bay Minerals at this stage, $324 million. So James Bay Minerals acquiring a near-term silver project is quite attractive. And I think the market hasn't yet priced in, even though the 30% increase, they haven't yet priced in the value of the company when production resumes. And I believe that we're looking potentially at early 2027, mid 2027 at the earliest. And so that could be a company with quite a bit of potential in the making. That's not to say that there's quite a bit of risk involved, because there is, of course, how far silver's run. And by the time James Bay Minerals restarts the Shafter mine, who knows whether the precious metals bull market has run its course and it restarts just as silver starts correcting, which could be quite painful if that is the case. So at this stage, I added some James Bay Minerals shares at 97 and 98 cents because I felt that the market is going to get excited about it, and off the back of a raging silver market, silver bull market, I think there's a chance for me to make some short-term trading profit and hold a significant stake for the restart. So definitely very exciting, and hopefully that answers the original question you had.
Yes, for sure. And I think a lot of investors or potential investors in James Bay Minerals have also got a quite good idea of where the company stands and if the valuation multiple that it's seen in recent times, especially this week, is justified or not. So thank you so much for that, Mr. Brian. And that does bring us to the end of this week's episode. We've clocked at 33 minutes and 40 seconds. So that is well within the time span that one of our viewers had recommended to us in the previous video. So hopefully they're happy, and hopefully you like this new format where we try to wrap things up between the 30 to 40 minute mark. We have noticed lately that short form content is helping the channel because it is getting a lot more traction, as well as feedback and good comments from you. So hopefully you enjoy this short form content, and thank you so much for watching. Once again, none of the content we discuss in this video qualifies as financial advice, and we recommend that you seek a licensed expert if you're on the outlook for the same. With that, thank you so much everyone for watching, and we'll see you next week in episode 11. Thank you.
Feel free to drop your comments and like and subscribe. Thanks a lot, everyone, and God bless.